I'm intending to wake you up with some ideas about financial management. And in this chunk, the fourth chunk of our lecture, we are going to concentrate on this time is money, or money in time, or value of money in time, or all these relations. But as well, we start from sort of feeling of money. And what does it mean? Something now, something in the past, something in the future. We will make a very small, some kind of exercise together. I would like you to think over, and then come with some how should I say, some results or reflection. Let's start. Sort of money in the perspective, and we start with like small numbers perspective, right? Let's imagine you have won in a lottery £10, and somebody asks you, okay, how would you like this money to be given to you? The £10 notes just now, or maybe £11 in a week, or maybe £12 in a month, right? We are today the 18th of October, so maybe 25th of October it will be £11. But on 18th of November it will be £12. What would you say? Okay? Let's think for about a minute. Maybe exchange opinions with your friends. How do you think it should be? It's very interesting, because definitely 11 is more than 10, and 12 is more than 10. But, maybe there will be an outbreak of pandemia and this money is not so sure. Or maybe there will be a very bad weather and it's got lost somewhere in transport. Or maybe this company for this lottery goes bankrupt. So yeah, it's sure, but it's never sure for 100%. Or maybe, obviously I don't wish, you will die and you will never consume this. Or something happens that you land, say, in a prison, or you become a monk and you cannot use it. I mean, many things could happen. So, have you thought about that? Say 15 seconds more to think about that. Right. Generally, when this exercise is made anywhere, people are convinced to take £10 note now, because it doesn't make a huge difference. £1 more, £2 more. What does it mean? It's not a big difference, not a big deal, and then this £10 notes could be gone, right? But then we come to next point of our thinking. And then the price is not £10, it's £100. And then what you prefer? £100 now, or £110 in a week, 25th of October? Sorry, September. In the previous words, I missed the month. We are in September, not in October, right? So in 1 week, £110, or in 1 month, it will be £120. Let's think, because now the stake is bigger. It's £10 and then £20. It's something. Previously, it was like £1. You could buy a sandwich. But now it's something more tangible. You could buy something more interesting. Okay? So What would you choose? Perhaps we will do a exercise right now, and my very honorable teaching assistant will help me right now to count. Okay, so by hand up, how many of you would get 100 pounds now? Okay, let's count. How many? Okay, I hope it's counted. Now, hands up. Who would take 110 pounds? I hope my teaching assistant would count how many in 1 week would take 110. All right? And now, the last question. How many of you, hands up, yeah, would take 120 pounds in a month? Okay? Let us count. Generally, when we do such an experiment, it comes sort of pretty even. People like spread evenly. Some would think, oh, it's worth waiting. Some people think, no, it's not worth waiting. It depends. Right, so now we will take number 3 in our sort of small exercise. But then when the price is 1,000 pounds, right? And then there is another offer, 1,100 in 1 week. So it's 25th of September, of course. Or it's 1,200 pounds in 1 month. So it will be 18th of October, right? So which number would you choose? Which solution? Oh, it's now tempting. When you wait 1 week, it's 100 pounds. It's quite a number of things you could buy. And then with 1 month, it's about 200 pounds. So it's quite a lot of money. What would you choose? Maybe we will do very quick voting. Hand up. Who is for 1,000 pounds now? Let us count. You know how many. Then, who is for 1,100 in 1 week? Hand up. Let us count. Okay, we know. And then who is for 1,200 in 1 month time? Hand up. I think it's counted. So my teaching assistant would account for that and will tell me later in this very small experiment. But then, could you see, because in proportion, you could see it's the same thing, like 10% more in 1 week and 20% in 1 month. In a proportion, it's always the same thing. But still, we tend to judge it differently. So, again, in intuition like behavioral finance, some things might be very important to judge. Right. Now we come to a small example that give us a taste of finance. It's just a taste. Today we are just talking about some taste, nothing too complicated. Say, this is like a real nice case that it's sort of developed, and then we could talk about this in detail. There is a company called Hotel Casino Paradise, and it's owned by a number of independently minded shareholders, owners, and these three are Anderson, Brown, and Collins. Yes, and they own some shares, like 1/3 of the company, like 100,000 shares. So it's like evenly split. Okay, and it's very good business. They own this business. And then there are some costs of the company, but Hotel Casino Paradise is a brilliant business, and it gives, like, it has an accumulated 3 million in cash, 3 million pounds in this respect. And then it could be like reinvested. We know it from a couple of minutes earlier. It could be reinvested in the company, or it could be paid to the owners as the sort of remuneration of their investment in the company. So the management of the hotel is sort of undecided, because it may be given to shareholders, means to the owners, as a dividend, but as well it could be invested in a different project, like a given event, big casino festival event. But now, very important thing, when we talk about finance, we really have to concentrate on definitions. So what is this dividend? A dividend is the distribution of some of company's earnings to a class of its shareholders as determined by the company's board of directors. Common shareholders of dividend-paying companies are typically eligible as long as they own the stock before the dividend date. Dividends may be paid out as cash or in the form of additional stock. Okay, this is like very nice definition. But what does it mean in like common language? So dividend is the part of the profit of the company that it's paid on a yearly basis to its owners. It is the earnings that the owners receive from the fact that they own the company. Am I clear? So if you own the company, it makes profit. Some of the profit may be sort of given to you, or all the profit may be given to the owner, right? This is the aim of the company. So this is dividend, like paying from the profit. Let us go back to this project of ours. So this sort of investment requires an initial cash investment of the whole 3 million, right? But it will produce a revenue of 3.6 million in a year's time. So, and then after it comes to an end, the sort of event, it is closed because it's like once. So if it happens, the accumulated revenues will be given as a cash proceeds to the owners. It means respectively 120 for each of the investors, like Anderson, Brown, and Collins. And how they behave, these investors, this is very important, because they have like different attitude. Because Anderson is the eager investor. He just doesn't care about any other projects, because he wants this dividend immediately, because he wants to have the cash and he wants to spend it. Brown is the patient investor. He thinks, if this project is a good one and it brings more money, so naturally he would rather wait, because then it will be bigger money next year. But then there is Collins, who is the sort of steady investor. He thinks, I would be in favor of this big casino festival, but it will bring more money, but I need some cash in 6 months to pay work on her house. So she would rather reluctantly but vote for immediate dividend. So how to solve this case? How to solve that? Is there any way of solving this? This is like quite a complicated for our level case. So how to solve this? So because eager investor wants it in now, patient agrees to wait, steady would wait but need money. How to solve that? How to solve this problem? Just before this sort of small break between the fourth and the fifth part, I just want to give you this example. Let us think, is there any sort of nice solution that we could really satisfy as management of the company? How we should satisfy our three investors? One wants the dividend right now, so this 100,000. But we know if we invest this 100,000, it will bring 120 in future. So it's sort of it's a nice business to do, but he wants money. Then the patient agrees. Okay, so this is fine. And then the steady needs some money, but in the sort of in the middle of our project. So how could we solve? I will show you, just without any big explanations. So, Hotel Casino Paradise takes 200,000 loan from the bank at the interest of 10%. So now we know it's lower than the earning the rate of earning of our festival, because it will be 20, right? So then it gives money to eager and steady, then invest earnings in the project, and then after that gives 120 to the patient, gives 2020 back to the bank, because it's like investor loan, and then because of the proportional earnings per investor, it pays as well 10,000 to eager and steady respectively. Okay, I was intending to give to you this example because I just wanted you to feel what it will all about. This is just maybe too soon for you, but it gives you the flavor of how the financial manager would work. Obviously, we will approach this financial aspects like one by one, starting very slowly from the value of money in time, and then we will take our attention to this changing of value in time and looking from different perspectives. We have found that the time is crucial for financial decisions, but then we'll have to work out some basic calculations. And I should say, yeah, we will do this. But before that, we have to make a small step back, because we just need to use our imagination about economics as a science. Where is it? Is it a science in the same way as, say, physics? Or is it a science in the same way as, say, English language philology or theology? Is it where is it? Economics and finance. I should say that we have to realize that economics is very much as medicine, in effect, because like in medicine, we know generally what happens if, or we could generally make a diagnosis of a certain illness, but it is not always exact, or it is not always exactly this illness. It could be a mixture of illnesses, or something extraordinarily rare, or something extraordinarily new. So economics as a science is very much as medicine. And then we might say that finance is like some kind of a section of economics. And as in medicine, we have to deal with the body and then the blood that makes everything work. This is very much the same in economics, where the blood in economics is the finance, is money. Money is the blood of the science of economics. What we have to learn, this is like some basic words for you to stick in the memory. We have to determine the future value of the investment made today. This is like money in time. Then we have to know how to determine the present value of the cash that is going to be received in the future. We have to bring it. I mean, you say in a week, but if we are going to receive something in 5 years, we should to estimate that. Then we should be able to find the return on investment. Like we put some money and then we have this return. How to calculate that? Then we have to know how long. It's like the question of time. We know the conditions and how long it takes for the investment to reach a desired value. Or, as another way around, we put something into the business and we expect that this money will be paid back. We just cover our expenses and it's called payback. So how long does it take? But unfortunately, before all of that, we have to make some definitions. It's very important that we know what we speak about. It's very, very, very important. So, when we talk about value, what is this? Value. It's very important to understand because we tend to mix price and value. Value is for somebody something, and then it's measured many values for many people in some kind of price. So value is represented by a precise amount of money in given currency. Let's be more simple. When I say about value, it's some kind of amount of money. But then what we mean by present value, right? It means how much something is worth today, more precisely just now. For the purpose of calculations, we think that is the current calendar day. So when we say it's worth £1,000 today, so it's today, present value of this £1,000 is £1,000. As simple as that. But then when we talk about investment, what we mean by investment? Investment is the action of putting a certain amount of money, a cash, into a project that should bring more money at a certain future date, or even generate some regular streams of money. So, say the future value of something will be like the value put into the future perspective. We'll talk about this in a clearer way in hopefully next lecture. But we should concentrate on these specific definitions, that we know what we talk about. Now we come to another set of definitions. When we talk about return. What is this return? Right. So we understand the amount of money received in future. Sometimes people say about return meaning the whole amount of money received. Sometimes people say about return meaning the amount of money after deducting cost, means profit. It's very important because some people say return in one aspect, people some in different respect. Okay, let's give some verbal, very short explanation. If I put 1,000 into the business, and after making this, say, one-time event, I receive, like I make a concert, like, okay, I put 1,000 in it, and then I receive 1,200. So some people would say the return, because we should specify later what this kind of return would be, 1,200. So, okay, we put like yesterday 1,000 into event, and today we just do the event and then we collect 1,200. So our return would be 1,200. But sometimes people say about deducting costs. So if we take 1,200 and we deduct 1,000, then there is 200 left, and it's like profit. And some people would say as well the return, but it's like profit, right? But it's very important to know that return, it's something that is returned to us as the investors after making this investment and conducting this investment. We will make some calculations later, it will be all clear, but we have to know the definitions. Then again, there's another question. What is payback? Payback means the amount of time in which the entire cost of the investment is returned. As per logic thinking, the amount of money received after this period will be treated as a kind of profit. Take the example. We put 1,000 in a project, and it gives us like 250 per year. Okay? So, like after the cost, like net profit. Okay? So, we just cash the money in the first year, we subtract the cost, and then we have 250. Then next year, 250. Third year, 250. Fourth year, 250. So we come to the like round figure after 4 years. It's payback. It paid us back in 4 years. Then the fifth is just a net profit on the whole investment. I hope I'm clear on that. We'll very soon make an example of payback calculation. But then as well we use an expression principle. What is the principle? The principle is the initial amount of money invested. So this 1,000 that I mentioned earlier invested is the principle. And then, yes, it's very, very, very important, interest rate. Definitions. The interest rate is the amount a lender charges for the use of assets expressed as a percentage of the principal. The interest rate is typically noted on an annual basis, known as the annual percentage rate. The assets borrowed could include cash, consumer goods, or large assets such as vehicle or building. Another definition, the proportion of the loan that is charged as interest to the borrower, typically expressed an annual percentage of the loan outstanding. Another third definition, an interest rate is the cost of borrowing money, or conversely, the income earned from lending money. Interest rates are expressed as percentage of the principal per period. We know now, we have the feeling how complicated and how important are the financial decisions for the company, because we have to manage the company's finances and take care about the future. calculate well what will happen in the future, because in some businesses this sort of span of interest, the span that the company will be active, is very, very long. So there is a lot of many factors that should be taken into consideration while doing the financial investment. So we know that already, and now we will learn about some basic calculations allowing to compare and measure money in different moments of time or in time. Anyhow, this is fundamental. We have to grasp it. We have to grasp it because otherwise the whole subject will be difficult. So we have to grasp the basics. So interest rate. This is the major concept. I will read with you the definitions because it's really important. It's not difficult. No, it's not a rocket science. It's not difficult, but it's very, very important. So there are many definitions, but let us read them. The interest rate is the amount a lender charges for the use of assets expressed as a percentage of the principal. The interest rate is typically noted on an annual basis, known as the annual percentage rate. The assets borrowed could include cash, consumer goods, or large assets such as vehicle or building. It sounds a bit complicated, but it's not, as a matter of fact. Therefore, we know the definitions, what's the principle, and other words. Let's concentrate on the second definition. The proportion of a loan that is charged as interest to the borrower, typically expressed as an annual percentage of the loan outstanding. This definition probably is sort of more understandable on the first glance, because we have the loan and there's some cost of the loan. Like, we take the loan, we have to return more. So the question is why, but we will talk about it later. It's rather that there is some like cost involved in that. And the third definition, an interest rate is the cost of borrowing money, or conversely, the income earned from lending money. Interest rates are expressed as percentage of the principal per period. This definition probably is clear, but let us concentrate on the issue. We have to stop it here for a moment. Why this interest rate? Why does it happen? When we return to the basics of economics and the basics of finance, we will find a situation. There are people who have an idea. Let's imagine it is a shoemaker. And this shoemaker has an idea of producing shoes. Right? Nothing complicated. But he needs some money. Because he thinks if he takes, say, if he finds $100, then he will buy some ingredients, briefly speaking. He will do some shoes, and then he will sell the shoes for about, say, 200, so he will earn a spectacular 100. Obviously, he has some cost, but never mind. So this is the idea. But then there may be another person somewhere close who has this 100. And the shoemaker says, I will take 100 and I will give you back this 100. And the other person would say, yeah, why? I cannot believe you because, perhaps you are not such a good shoemaker. Yeah? Nobody knows. Or there will be a war or something, and then this business will not work. Therefore, the person might say, okay, if we do it, you have to return to me more. Because, I instead of giving you this 100, I could go and buy myself 100 cakes and I could eat them, consume. So the interest rate in general concept is sort of a reward for not consuming. Because if you have 100, you could do what you want. Travel, eat, enjoy, whatever. Buy your things, consume. But if you are not consuming and you are like postponing this, there should be some kind of reward for that. Obviously, on the other hand, there are people who are keen to find money, and then they will make more money very quickly, so they are very well okay with the situation to give you some reward for that. So this is the basic concept of interest in the science of economics and finance. Yes, I stopped on this slide for about 5 minutes or even more, but I think it's very important that we grasp mentally the concept before going to simple calculations. Right, so now just a bit of an example. Yeah, the example in practice, in normal practice. So we have this formula: interest rate, total repayment amount minus amount borrowed, divided by amount borrowed. Yeah, this is what you have to repay minus what you have taken, a certain amount, divided by what you have taken. So we are in tourism business, so let's assume hotel company is considering buying a new 50 million hotel. Fine. Bank agrees to let hotel company $15 million. All right. But then, bank says, I might go, might not go. We will charge you. So the bank requires to pay back 55 million at the end of the year. It means after 365 days. And one can calculate that the hotel company will pay 5 million. Okay? 55 million repaid minus 50 million of the principal. I think it's quite clear. In order to borrow this money. And then this translates into interest rate is 5 million divided by 50 million means 10% interest. That is an interesting question, sort of philosophical, or in science of economics, why the interest rates are normally sort of charged on a yearly basis. It's very interesting question, but we have to again track us down to the previous times when people were like farmers and they operated in yearly cycles. In Europe as well as in China, they are very distinctive measure of a year because the things repeat generally in the nature on a year basis. So if something is depending on a year, like have to sow and then collect grains, for example, or fruit, things like that, or you chop wood, then it's on a yearly basis. Therefore, people traditionally treat it on a yearly basis. Now, alternative way to have a close look on interest rate in practice is like that. The interest rate, total repayment amount minus amount invested divided by amount invested. Let's assume hotel company is having some cash. They want to invest in a new hotel or a new restaurant, but later. So they have some cash. And they know what to do with the cash. But there are other companies that are eager to borrow some cash because they have like quick business to do. And they will turn the money quick. So therefore we have banks and the hotel company pays the amount of 100 millions into the bank, because bank wants to attract deposits to lend to other people later. So banks offers more money after a year. So if the company keeps the money in the bank for a year, then after this time the company will have on account 104 million. Then we could calculate that the hotel company will receive 4 million. So 104 million received minus 100 million principal. So this translates to interest rate is 4 million divided by 100 million. It's 4% interest on this investment. I have stopped for a significant amount of time on these very fundamental issues of interest rate, because we will say about time value of money and using expression interest in percentage many times. Without that we cannot move. So I wanted you to have a very good and clear background in order to understand what will happen later.